It better be different this time. Those are not my words. That is the chilling, five-word warning coming directly from one of the world's largest financial institutions, Bank of America. It's a phrase whispered in the highest echelons of Wall Street, a stark message that the ground beneath our feet might not be as solid as it seems. Because according to their latest bombshell analysis, the US stock market, as measured by the S&P 500, has officially reached a level of speculative frenzy that eclipses even the legendary peak of the dot-com bubble in the year 2000. We are in uncharted territory, floating in a sea of optimism powered by a single seductive idea. The primary fuel for this dizzying ascent is a technology that promises to remake our world: artificial intelligence. The question that should keep every investor awake at night is terrifyingly simple. Are we witnessing the birth of a new economic paradigm, a genuine revolution that justifies these nosebleed valuations? Or are we living through the final, euphoric moments of a historic financial bubble, just seconds before the pinprick that vaporizes trillions of dollars of wealth, just as it did for a generation of investors who bet it all on Pets.com? Today, we are diving deep into this critical warning. We will meticulously compare the AI mania of today with the internet insanity of the late 90s, uncovering the crucial and frankly terrifying differences. We'll hear from other market veterans who see the storm clouds gathering, and we will expose the hidden mechanism in today's market that could make the next crash happen faster and more violently than ever before. Most importantly, we'll look at the playbook for what comes next, because in every crisis, there is opportunity. Let's begin. The heart of Bank of America's warning, delivered by their strategist Michael Hartnett, revolves around a key metric known as the price-to-book ratio. Now, without getting too technical, think of this as the market's hype meter. It compares a company's stock market value, what people are willing to pay for it, to its actual net worth on paper, its book value. The book value is the gritty reality. It's what would be left over for shareholders if the company went bankrupt and sold off all its tangible assets, its factories, its inventory, its cash. The market price is the dream, the story, the hope for future profits. During the dot-com craze, the dream massively overshadowed reality, and this ratio for the S&P 500 hit a peak of 4.8. It was a number so high that it signaled the market had lost its mind. Well, as of mid-August 2025, that ratio has soared past that historical red line. It now stands at over 5. Let that sink in. The overall market is now, by this crucial measure, more expensive than it was at the absolute zenith of the most infamous stock market bubble of the modern era. This isn't just an abstract number. It means that on average, investors are willing to pay $5 for every $1 of a company's actual, tangible net worth. The other $4, that's pure faith. Faith in AI, faith in future growth, faith that this time truly is different. Hartnett's analysis points the finger directly at this AI gold rush. A handful of mega-cap tech titans, like the chip-making Goliath NVIDIA, and the software behemoth Microsoft, have become so valuable that they are single-handedly inflating the entire index. Their stocks are trading at premiums that demand nothing short of flawless execution and a world-changing technological revolution, with no room for error, no economic hiccups, no unexpected bumps in the road. This is what prompts Hartnett's ominous line, "It better be different this time," because if it isn't, the fall could be just as painful as it was a generation ago. The comparisons to the year 2000 are as inevitable as they are unsettling. Back then, the promise was the internet. Any company that slapped a .com on its name saw its stock price launch into the stratosphere, regardless of whether it had a viable business model or even any revenue. It was a broad-based mania, a party everyone was invited to. But here's the crucial, dangerous difference that Hartnett and other analysts are flagging. Today's bubble may be even more precarious because of its incredible concentration. While the dot-com froth was spread across hundreds of tech companies, today's gains are largely confined to a small club of AI beneficiaries, often called the Magnificent Seven: Microsoft, Apple, Alphabet, NVIDIA, Amazon, Meta, and Tesla. The entire market narrative, the performance of millions of retirement accounts, is being driven by the fortunes of just 7 companies. Think of the market as a Jenga tower. In 2000, hundreds of smaller blocks were being pulled out, making the tower shaky but broadly unstable. Today, the entire weight of the tower is resting on just 7 massive blocks at its base. If even 1 or 2 of them crack under the pressure, the entire structure could come crashing down. This concentration creates a terrifying vulnerability. These companies are also deeply interconnected. Microsoft, Alphabet, and Meta are all massive customers of NVIDIA's AI chips. A supply chain disruption for one becomes a growth problem for the others. A regulatory crackdown on one company's AI model could have chilling effects on the entire group. If one of these giants stumbles, if their growth forecasts are even slightly missed, they could drag the entire S&P 500 down with them, creating a cascade of selling that the rest of the market is simply too weak to absorb. This extreme concentration risk is a fundamental piece of the puzzle that many investors are simply not talking about. If you're finding this breakdown of the market's hidden dangers insightful, do me a favor and hit that like button. It helps us know we're on the right track. The warnings don't stop with Bank of America. Other strategists are echoing these concerns, adding their own layers of anxiety. Tom Essay of the Seventh Report points to the semiconductor indices, the very heart of the AI revolution, as a potential canary in the coal mine. He warns that their sky-high valuations could lead to a considerable downside for the entire S&P 500 in the coming quarters, especially if the economy shows any signs of faltering. And what could trigger such a faltering? The list is familiar but no less potent. A surprise re-acceleration of inflation, forcing the Federal Reserve to raise interest rates again. A flare-up of geopolitical tensions that snaps fragile global supply chains, particularly for advanced semiconductors. Or even the simple, mundane reality that corporate profits can't keep up with the sky-high expectations. Anything that disrupts the perfect scenario that is currently priced into these AI stocks could be the pin that pops the bubble. This vulnerability is then magnified by a modern market phenomenon, passive investing. Billions of dollars are automatically funneled into index funds, like those tracking the S&P 500 every month. These funds don't pick and choose stocks based on merit or valuation. They are forced to buy the biggest companies in the index, whatever their price. In a bull market, this creates a powerful feedback loop, a river of dumb money pushing the leaders ever higher, regardless of fundamentals. But in a bubble, these same index funds become bubble amplifiers. They mindlessly pour capital into the most overvalued companies, creating the illusion of stability while actually concentrating risk. Investors think they're diversified because they own an index of 500 companies, but in reality, over 30% of their money might be tied up in just a handful of those AI leaders. When the tide turns, that river of money can reverse into a waterfall, with automated selling amplifying the crash. Of course, not everyone on Wall Street is a pessimist. For every warning of a bubble, there is an optimistic voice predicting a new golden age. Some bold forecasts, highlighted in outlets like Business Insider, predict the S&P 500 could surge to an incredible 7,000 by the end of the year. Their argument rests on the idea of a decoupling. They believe the AI productivity boom will be so powerful, so transformative, that it will create its own economic reality, immune to the stagflationary pressures that might plague the old economy. They argue this isn't a bubble. It's a fundamental repricing of assets in the face of a genuine technological leap forward. They point to AI's potential to revolutionize everything from drug discovery, cutting the time to develop new medicines by years, to creating fully autonomous supply chains that eliminate logistical bottlenecks forever. This isn't just about a faster internet, it's about a fundamental rewiring of the global economy, akin to the dawn of the Industrial Revolution or the invention of the automobile. This is the great debate that will define the market for the foreseeable future. Are we in a sentiment-driven, speculative bubble destined to burst, or are we at the base camp of a new supercycle of growth? The answer will determine who builds generational wealth and who gets wiped out. And this is where the savviest investors start thinking differently.
Instead of just betting on whether the bubble will pop, they start looking for the opportunities that the bubble itself creates. Richard Bernstein advisors, for instance, point to the reckless abandon with which investors have dumped everything that isn't a Magnificent Seven stock. This mass exodus from non-AI companies, from energy, financials, industrials, and international stocks, has potentially created incredible bargains hiding in plain sight.
They argued that post-bubble opportunities, much like those that appeared after the year 2000, will be found in the very sectors that everyone is ignoring today. While the Nasdaq was collapsing in the early 2000s, boring value stocks and commodities went on a historic, decade-long bull run. History suggests that the biggest opportunities are often born from the ashes of the last mania. This brings to mind another stark warning from Bank of America, issued earlier in the year, which forecasted a potential 40% drop in the S&P if these mega-cap growth stocks deflate, drawing a parallel to the Nifty 50 era of the 70s, another time when the market fell in love with a small group of unbeatable stocks right before they crashed. Navigating this treacherous landscape requires a different mindset, one that looks beyond the daily headlines and prepares for multiple outcomes. If you want to stay ahead of the curve and get our deep dives into where the smart money is moving next, especially in uncertain times like these, make sure you subscribe to the channel so you never miss an update. So as we head deeper into 2025, the market is walking a tightrope. The interplay between Federal Reserve policy, corporate earnings, and most critically, the real-world return on investment from AI will be pivotal. Will artificial intelligence actually deliver the massive productivity gains and profits that are promised? Or is it a sentiment-driven gamification of the market, destined to fade when the quarterly earnings reports can't match the hype? Michael Hartnett's stark assessment is more than just a market call. It's a call for prudence. In a market where valuations seem to have detached from gravity, the margin for error is razor thin. The binary outcome is clear. Either AI transforms our economy at a pace never before seen in human history, justifying prices that seem insane by historical standards, or the air will come out of this bubble, potentially leading to a lost decade for investors who are all in on the current leaders. For those who understand history, for those who can balance caution with selective optimism, the moves you make now could very well define your financial future for years.